Hey guys, it's Markets with May, and this is my summary from listening to 400 earnings calls in Q2 2024. There's no trick to this, as my followers know. I listen to 400 earnings calls per quarter and review the documents. I've been doing this for quite a few years at this point. Now, I do this because it gives me a great view of the macro. I get to listen to 400 CEOs tell me what they believe in their industry they are seeing on macro. I get to compare that across companies, and also I get to hear what the analysts are thinking and the types of questions they're asking and how management is then responding to it. And that's aside and above and beyond what I actually see in the earnings part. Now, in my Twitter feed, I'll actually write individually each company what I'm seeing as they're coming out. But in this video, I'm going to kind of do a summary and really keep it even tighter than some of the posts that I've done on macro from the CEOs. So we're going to discuss the overview, what I saw big picture, and then I am going to give 5 industry takeaways that I think are relevant. If this is valuable to you, you can like, share, comment below. You can follow me on Twitter, now known as X, or if you want to send me a super thanks, that's awesome. I'll just get some coffee with it. Thanks, guys. Now, let's get into what I saw this quarter. Now, was it a strong quarter? Yeah, it was a really strong quarter. For context, I'm showing about 67% of the companies coming in what I would consider growth year over year on the quarter. And that's compared to last quarter that was sub 60. And actually most quarters that I've listened to this entire decade have come in sub 60, except for that one weird blip on the easier comp post-COVID. So this was a crazy strong quarter from everything I listened to. However, the notes really provided a lot of nuance on the macro. Now, most of the companies guided very conservatively, meaning they were not necessarily baking in a rate decrease in the second half. Now, I want you to understand that I have to draw the line on a very specific date, and the date I chose was June 1st. So if a company reported in June, they didn't have the economic data that came out later in the summer that really has moved a lot of folks to thinking that for sure the Fed would decrease rates in the second half. The question might then be, did the companies that report later become more constructive? And the answer to that is no. Even though as the quarter went on, more folks felt less scared to say that their gut was telling them you'd get a decrease in rates in the second half, almost all indicated that they were not baking in quantitative easing or anything but a conservative stance going into the second half. That tells me the guidance that most companies gave in large cap land and the S&P 500, quantitative easing for the US or even for other countries is just not baked into the numbers. It's part of the reason why it's really hard for me to be bearish, except for something else happening on the macro front. That brings me to 5 other items I just want to discuss that have bigger macro impact on the supply chain or how you would look through the cycle. The first has to do with China, how it's impacting different industries. The second has to do with energy and the grid, the electric grid. The third has to do with the semiconductor space. The fourth, healthcare. And finally, I want to talk a little bit about insurance because it's top of mind for so many folks. Now, what I want you to understand about China is that going into the quarter, your strategy was already done. And in fact, a lot of companies announced a China strategy going into the conflict in Ukraine because of the relationship between China and Russia. And those strategies really played out this quarter. Quite a few companies had already massively pared back their exposure to China, but still some could not do that. And that was particularly true in industrials and in materials. The way they expressed it, though, had to do with inventory pare down. And that's another way of saying that people ordered more than they could sell. That said, because of the nature of how China works, an industrial company doesn't necessarily roll out of China just because there's weakness there. The problem with doing that is that you may never be allowed back in. And there are actual benefits both in production and there are subsequently exports, and the fact that if you're not located in China, sometimes you won't be allowed to sell to Chinese companies. Now, what did those CEOs see? Across all of industrials and materials, most of them see minor pickups in the second half, lower than they would have originally anticipated going into the year, but it's really a 2025 story. Now, consumer discretionary consumer staples is a totally different animal. each one of those companies had a lot more flexibility on precisely how they wanted to manage their strategy, namely, did they want to sell in the country or not? And if they did, how much effort did they want to put in that direction? You had a lot of companies selling off, not just Asia, by the way, or China, but also Europe, and coming back home to the US. Companies like Procter and Gamble and a lot of the staples did this. In that regard, the autos are a mixed bag. People pretend like only Tesla's in China, and that's just not true. Most of the auto parts, as well as Ford and GM, all have exposure to China. That said, the JVs that GM and Ford have are structured a little differently and protect them slightly more than, say, a Tesla. Now, if we're talking about consumer discretionary, luxury mattered, and mostly those guys are slightly buffered, with Ralph Lauren and Lululemon actually reporting pretty good in China. In contrast, the other names, it kind of depends company by company how it went. Now, the one caveat actually is hotels. The hotels were doing slightly better, I want to say, in China. Not great, certainly not where you used to see this crazy growth, but not terrible. The casinos, which all have China exposure through Macau and then Greater China, they're doing fantastic, but they really took it on the chin post-COVID and have been slowly but surely recovering every single year. Now, the one group that talked China and actually hasn't been there since pre-COVID is the cruise liners. The cruise liners have been busy taking care of their debt and doing a whole host of really cool things in North America, Caribbean area. But I'll probably have to do a separate video for that. And if you'd like that, definitely stick it down below. The cruise liner legitimately are to be watched. It sounded to me like China for the cruise liners is a 2025 story. Now, usually I do energy separate and utilities separate, but right now the story really is all the way through. Now, the COVID bill that came out allowed the electric companies to upgrade the grid. And for a long time, you were seeing these really awkward numbers because CapEx was so high and the rate cases hadn't gone through. You also have this incredible trend of businesses shifting where they're going and also doing very energy intensive things, which we will get to next, such as data centers. And that had numbers looking ugly for the first 2 years post-COVID, but now you're starting to see the benefit of it. And this quarter was probably one of the strongest quarters from a pure, how did earnings do versus the previous quarter. I want you to understand that I rate the utilities a little differently than other companies because regardless of whether revenue goes up or down, I care about margin expansion and how did the rate cases go or what are you thinking is coming up. And I do that because if you think about it, a bunch of the utilities companies are still regulated. So the fact that they're charging you less for your energy bill but making a bigger spread in margin is fantastic because revenue is really just telling me about population growth. It's not telling me about whether or not the companies run better. This quarter was crazy because I saw both, companies charging less but having these massive increases in earnings given rate cases that worked in their favor, plus the fact that the CapEx they did is working. But also, I saw some companies that had crazy high revenue growth and also crazy high earnings growth as well. Now, hopefully what that implies is that energy bills will be coming down in the states that those companies represent. Clearly, I'm going to be monitoring that because that is a component of CPI and therefore inflation. Now, what the utilities companies really do tell you is whether that demand for energy is real and what it's coming from. And in that case, I'm going to segue to my third point, which is what in the world is going on in semiconductors and technology. Now, what the utilities companies told you is the reason they're upgrading the grid, the reason why there's funding, both public and private funding for it, is because data centers are requiring more energy usage. So let me be crystal clear. The AI build out is actually taking more energy, specifically via data centers. There's lots of controversy on whether or not that will continue. I actually think it does continue for some time into the foreseeable future. But 100%, there is build out happening. And I saw it in the utilities companies. So we're not even at the semiconductors yet, my friends. Data centers who are trying to plan for where their buildings are going to be at a lower cost energy usage. I saw it in the downstream oil companies who are freaked out that they cannot provide enough nat gas to fuel utilities and the grid, and realize that if they don't provide enough nat gas The answer isn't that we do nothing. The answer is coal, which is the worst possible polluter. And then I also very clearly saw it in the CapEx, and not just the CapEx from the mega tech big cap companies, which absolutely reported an increase in CapEx, but I really saw it across every single company. There wasn't one company that didn't have a specific AI strategy, and even if they did have flat to only slightly up CapEx relative to revenue growth, the allocation of budget was still going to AI. Now, healthcare was a mixed bag, okay? You've got some that had drugs that are more elective in nature or require people be booked in a little tighter at the hospitals, doing really well. So med devices did okay. A lot of the drug companies, particularly Lilly with some of the new blockbuster drugs, are doing great. And even if you were leveraged towards surgery because the comps were easier, you did fine. So ISRG, which does big surgical equipment, modernizing it, they did fine. Who didn't do fine and is still struggling are companies that are leveraged to Medicare, because Medicare won a big battle at the expense of all these guys, probably rightfully so. But Walgreens and CVS, they've got to figure that out because drug distribution is just not doing it the way that it used to. So the last thing I'm going to talk about is insurance, specifically property and casualty, because it apprises such a large component of inflation. It's a huge part of what continues to go up in CPI. But anyone that's asked me to find evidence of the property and casualty guys themselves gouging, I haven't been able to find it. And that's because the metric that matters, that really demonstrates that they would be overly profiting, is the combined ratio. Now, if you give me a follow, I promise I will one day do a video on what precisely the combined ratio is and how to interpret it. But essentially, if that combined ratio is over 90%, these guys are not gouging. And while more than one reinsurer was living their best life with a combined ratio well under 90, the proper property and casualty folks were doing everything they could to keep up with inflation, and also, major problem, the fact that only one side of an accident was being insured half the time. Now, this quarter was a little bit better in my opinion. You did have some of the P&C companies coming in right at 90 and slightly below. I, however, did see a few that were coming in below 85%, which to me puts you in the territory of, hey, you could lower rates, my friend. Now, part of the reason that that's happening is because with rates having been held so high for so long, you are actually getting investment returns that are a bit higher, taking pressure off. Now, one quarter at sub 90% combined ratio isn't necessarily enough to get the insurance companies to lower their premiums, but if you have multiple quarters that way, then either you'll have legislation come in, or alternatively, you'll just have new players come in and write that policy for something that is just a better pricing for the consumer. Now, two areas I'm not covering in this video are real estate and the financials. I'm going to cover real estate in a separate video, and for the financials, I'll just do a preview of the banks as a separate video. If this was helpful to you, please like, share, comment. I love that kind of thing. And until next time, good luck in these markets.